Winston just said to me, Felix, do you know my favorite burrito place is doing a 50-to-1 stock split, the biggest stock split in the world? And I said, Winston, you better lie down on that news. But what I want to walk you through here is a little more than that. A, what is a stock split? Why do companies do them? Why now? Why is Chipotle doing this now? How will that actually affect the share price? Is this a massive opportunity for us? And is Chipotle a good investment? And on that note, for you to get max value out of this, I've also put together all my research on the stock, and you can download that for free at felixfriends.org/Chipotle. Now, I used to think this was pronounced Chipotle, but that goes to show what this German weird YouTuber knows. I've never eaten one, actually. Never eaten one, never come across one. But it doesn't mean we can't look through the numbers, through the eyes of an investment banker, which is what we're going to do here. So let's start with what is a stock split and why do companies do them? So the way I like to think about that is, well, you're basically taking your existing number of shares. So say you have only one share in the company. You are the owner, and there is just one stock certificate out there, like it used to be in the good old days when you had physical certificates. My grandmother had physical stock certificates. She was a very, very smart woman. And what do? Well, you simply cut it up. So you simply go, I'm going to separate this into a bunch of stock certificates. And now I've got 2, 4, 6, 8, 10. We did that well, didn't we? So now we have, rather than one share of, say, $100, we now have 10 shares of $10 each. So if you own those 10 shares, or the one share, it makes no difference to you. It's exactly the same thing. So why do companies do them? What's the point of this whole exercise? Why is this the biggest stock split in the history of stock splits? Well, it's very simple. The Chipotle share price is something extraordinary, like $3,000. And it's hard for people to buy $3,000 shares. It's hard to trade them. It's hard to do options trades and much, much more. But I'm going to actually play you a little clip here from the CEO who explained this very, very well. So let's listen to the man himself, and then we look back at how is this going to affect the price of the stock.
When we study this every year or so, we have our bankers come in and we talk about the pros and cons of doing a split. And cost was never really a big problem for us, but we couldn't really find a compelling reason until recently. And there's two reasons really that led to this split. One is our employees. It was getting harder and harder for us to get the right denomination because we reward our top performing managers with stock in the company. We want them to celebrate our success with us. And it was getting harder and harder where if you wanted to reward a manager with $4,000 worth of stock, you'd either have to award $3,000 or $6,000. So that made it a challenge. And also when their stock would vest, the withholding made it tough too because the withholding could only happen in full value shares. And so if you had, let's say let's say you had $3,000 worth of value that was created, the only withholding you could accomplish was one full share, which basically would wipe out most of the value. And so for that reason, that was a big reason for us to do it. The second one, though, about a year ago, our investors started telling us that separately managed accounts were a real problem to get liquidity. These accounts typically, I'm sure you know this, Jim, they tend to be small. They tend to be in the 50,000 to 100,000 range. But in total, they're the fastest growing investment class, and they total now over $2 trillion. So it's a lot of small accounts that add up. So if you got a $50,000 account, your choice is either to have no exposure to Chipotle, or you have to over-index and get a 6% exposure to Chipotle when our stock is trading at 3,000. Those two reasons combined, Jim, cause us to say, let's do it. Let's go ahead and do the split.
So the CEO made a pretty convincing case, right? Essentially, small investors and pension funds and so on that have small accounts, they can't add necessarily a $3,000 share. If they only have a $10,000, $20,000, $30,000, $50,000 portfolio, that's a big allocation. They have an issue with share-based compensation. So bonuses, right? It's harder to give people either 3,000 or 6,000. You might want to have given them 4,000 or 3,500, but you can't. You have to always jump in these great big kind of jumps there. So there are quite a lot of good reasons for this. And I would add one to it, options trading. I'm an options trader, and we can't really trade the stock because the trades are so large and so expensive that there is no volume because nobody wants to trade it. Once this happens, I think there's going to be a lot more ability to trade the stock and actually make money out of it that way. So is it a good idea? Is it a bad idea? Well, think back. Is this actually, it's probably a good idea. From an ownership point of view, whether you own one share or you will soon own 50 shares, it makes absolutely no difference. Why does it make no difference? Well, say the one share is worth $3,000 right now. I just want to keep the math simple. And you divide 3,000 by 50, you will then own 50 shares of $60 each. So 60 times 50, you still own $3,000 worth of Chipotle. So you own the same thing. Doesn't matter. Potentially, there is an increase in demand here from people who have previously been unable to buy the shares. There could be a little bit of an increase in demand that could be beneficial, but probably doesn't really move the needle all that much. Right? So if you thought that stock splits were this amazing thing where everybody makes money guaranteed, it's typically more hype, typically more noise. And yeah, there are examples like Tesla and so on, where they have done the stock splits and the stock's gone up. But that was more driven on social media saying it's a good thing and people not really understanding it and therefore buying it. And the same could happen here. But fundamentally, it actually makes bugger all difference how you own $3,000 worth of a company. Lots of shares or one share, right? So there we are. Also, fractional share ownership is a big thing nowadays, so it's made it a little bit easier, but still, I think there is some benefit in what they're doing here. I get it. Now, the next question then is this a good investment? Burritos. Right? Mexican grill. Is this something we should invest in? And, you know, I don't think I've ever invested in a restaurant chain before. And I'm a bit of a food snob. I readily admit I like burritos, but I've never eaten in a Chipotle Mexican grill. There isn't one near me. But look at the business. Cash flow, brilliant. Growing very nicely. Profit health is out of this world. Now, what I don't like is that the price has gone up a lot. Price momentum is very positive. And relative value seems, wow, this seems expensive. But we can look beyond that. Sometimes there's something in it that actually justifies that, right? And they make burritos and burrito bowls and quesadillas. When did bowls become a thing? People are like, I'm just going to take a bit of food, I'm going to put it in a bowl. Now it's a different thing. No, it's not. It's still the same food, but in a bowl. Anyway, there are YouTube channels and Instagram channels dedicated to bowls. Very, very weird. But anyway, gross profit margins at 40%. You know, I genuinely like 60% plus and more. So it's probably pretty good for a restaurant. But yeah, revenue 10 billion. Wow. 1,300 million or 1.3 billion in net income. So that's a 13% net income margin. That's pretty good, I think, again, for a restaurant. But this number actually like blew my socks off. Not that I wear socks. I hate socks. Who likes socks? I mean, seriously, it's a constricting thing around your ankles. It's the oppression of the working man and all of that. I basically wear shorts and no socks all day long. Well, you gotta live in the tropics to do that, but that's why I live here. I grew up in a place that was very, very freaking cold, northern Germany. Minus 20 Celsius, bloody hell. I don't know why people live there. Why do people live in Northern Europe? Tell me. Or the Northern Europeans, I know, offended. Return on invested capital, 18.6%. Long-term earnings growth, 22%. I usually take these two numbers and I go, I would expect the stock to go up by 18 to 22% in the long run. That's a rule of thumb. Literally, it's a very simplified way of valuing a stock. It's not financial advice, but that's extraordinary. I was not expecting that. I was not expecting a restaurant chain, and the Frenchies are going, this is not a restaurant, you know, because they think restaurants are very fancy places. They are very fancy places in France. I'm going there next week. I'm going to eat all the fancy food. And then I'm going to sit down and tell them, by the way, I'm a vegetarian. And then the French chef has a heart attack. I do enjoy it. So torturing the French. What do you do in May? I go and torture the French. And all right, let's look at the numbers here, right? What about debt? 4 billion debt. Is that a problem? Well, let's see. How much do they spend on that? About 560 million a year, I would think. It's quite high, right? That's like 8%. That's more than that. It's like 12% or something. So quite high financing cost. But they have 1.3 billion in free cash flow. So in 3 years, they could be debt free if they wanted to. Probably don't want to, but they could be. So it makes the debt actually okay. No issue with that. And I guess you've got to buy stuff, right? You've got to buy Dorito flamers or whatever you want to call them. And then let's look at how good's management. EPS, earnings per share, profit per share is what we look at. Last quarter, massive beat. One miss here in 2022, no idea why. Beat, and revenue is a little bit more up and down, but I don't really care whether you sell more burritos. I just care whether you sell burrito more profitably. Maybe that's where the bowl comes in. You can save on the dough, right? You can save on the bread. Maybe that's the secret. You just give people cheap rice. Maybe rice is cheaper than the wrapper. There could be some logic in that. So very, very good quality management. Now, is this thing expensive or cheap? It's trading at 56 times PE. Whoa, okay. That's a lot for a restaurant. 56 years of profits. So at the moment, the end of this year, your shareholder yield is less than 2%. Less than 2%. That's like a lot worse than buying a treasury yield. So I'm thinking, okay, is growth out of this world in terms of profit? 20, 18, 20. Maybe analysts are a little bit moribund and depressed on this and they don't really get it, that a burrito bowl can make more money than they are on Wall Street and their fancy little midtown vests and all of that. So maybe they're lowballing the figures, but I even if I hold on to this thing for like 5 years, I get to 23 times PE. Let me give you some perspective on that, okay? So other restaurants, the Frenchies are having a heart attack. McDonald's, right? Trades at 28 times PE. How about Microsoft? Microsoft trades at 35 times PE. So it's cheaper than burrito bowls. How about NVIDIA? NVDA, arguably the innovator of all innovators with incredible moat and massive, massive profit margins. Well, at a 2-year forward PE, you might be thinking, Felix, you're getting a little bit fancy here with the forward PE thing. So basically at 2025 here, I mean, we'll do this in green. We'll do this in NVIDIA green. At 2025, NVIDIA's PE is 28. Burrito bowl here is 47. So until somebody tells me, and I'm relying on you here in the comments, why the burrito bowls at Chipotle are the most life-changing burrito bowls that anybody has ever tasted, and possibly explains the massive immigration you're getting from your southern border in the US, because they really all just want to get to California and eat the better burrito bowls. Mexicans and everybody else is arriving. And yeah, I think I'll stick with probably Microsoft or NVIDIA, who are cheaper right now. And arguably have it easier to grow because think of it this way. And that's always how I look at a business. And we'll look at a bit more here in terms of stock charts in a second. But if I sell one extra product, what's the cost? What's the cost? Okay, so let's look at Microsoft. And let's look at Chipotle. And I'm not dissing the stock. It's obviously a very well-run business. We're talking about Just. It's a very well-run business. Just trying to get my head around evaluation. If you buy an extra, if you sign up to Microsoft Office 365 today, right? You go on the website, you fill in a few things, put your credit card in, and they'll keep it forever after and charge you forever after. And Island Bill is a little jiggy somewhere with an underage girl. Sorry, I took that back. I was obviously referring to somebody else. You know, mind, I don't know all of that. We take that all back. Island Bill is a wonderful man. A savior of the free world and all of that. And what happens? Well, it probably costs Microsoft pretty much zero to have you as an extra subscriber. Okay, it's a teeny tiny bit of download capacity on a cloud server somewhere, and there is a processing charge for the credit card. So say it costs them 50 cents, right? Chipotle sells you an extra burrito, and I don't know what their burritos cost, but to make a burrito is going to cost you something, right? You got to buy some beans and some ground stuff and some, I don't know what else they put in it, sauces and so on. So it's probably going to cost you $1 to maybe, I don't know how much it costs. You got to pay the staff to wrap it, to do it. You know, if all the tables are taken in your restaurant, do you actually have to open another restaurant? And so it's probably going to cost you $1 to $2 marginally to build that product. So therefore, I like these kind of businesses with very, very low costs per additional customer, and you can scale. So my money at the moment would sit in tech rather than in burrito bowls. Now, when I come to the US next, I shall go and eat a burrito bowl, and maybe that'll change my mind. But yeah, let me know down below, seriously, in the comments, what you make of this. The stock has massively outperformed the S&P. This is burrito bowl stock, and in yellow we have the S&P 500, and numbers are good, but valuations are rather rich, and in a way this explains why it's gone up, because free cash flow in red here is free cash flow is pretty extraordinary, and the stock basically moves in line with free cash flow. So I'm not saying it's not justified. I'm just saying it's probably not the greatest entry point in the world. Let me know what you make of this video. If you like it, if you enjoy it, if you want to know more about burrito bowls, we can dig into this a bit deeper and download the full research we have, even much more detail than we looked at here today, to make you into the smartest burrito bowl investor out there. felixruns.org/Chipotle. And if you enjoyed the video, share it with a friend. I thank you for watching. A chief financial analyst, Tallulah, just asked me, Felix, what are the 3 stocks you'd be buying right now? And I thought, let's do some research on that. And we did, and we came up with 3 names and a bonus name. So it's actually technically 4 names. And I'm going to not just tell you what the names are, because that wouldn't be very useful to you, but actually how we came up. What's the